Maverick Trading, powering the world, one trader at a time. Hello and welcome to the Maverick Trading Special Session, Trading Bear Markets. I'm Darren Fisher, CEO of Maverick Trading. Let's get started. We haven't seen an extended bear market since the last one ended in 2009. It's April of 2022 right now, so that's 13 years. There's an entire generation of investors and traders who have never seen market conditions like this, and many of them don't know what to do. If you don't know what to do, you could very possibly incur huge losses in your portfolio, setting you back financially for years to come. That's a scary proposition for the uninitiated. But if you know what to do, there's no reason to sit through the pain of a bear market. Look, knowledge is power. If you know what to do, at the very least you can preserve your capital. If you know what to do, and we at Maverick Trading do, bear markets can actually be very good times to actively make money. Just imagine having the ability to actively make money when all the financial pundits on TV are telling everybody that everything is going down the tubes. That puts you in a powerful financial position regardless of whatever is going on inside your day job, the country, the rest of the world. We need to set the stage, so to speak. So to begin, we're going to talk about pullbacks, corrections, and bear markets. Basically, what are their differences and how do you identify them? Next, we're going to talk about the difference between investors and traders and what their options are in a bear market. After that, we're going to talk about changing your mindset. Like I said, we've been in a bull market for 13 years. We've been programmed to believe the markets will always rise in the long term. There's a certain amount of mental gymnastics that you're going to have to commit to performing if you want to be profitable in a bear market. In order to make money in a bear market, you'll have to learn the strategy and techniques that make people successful in a down market, and we'll talk about some of those. The most successful traders at Maverick are multi-asset class traders. They've usually gotten their start in the markets and stocks, but then branch out into options, Forex, and crypto. If you're already trading Forex and cryptos, there are some things that you need to know about trading them in a bear market. Finally, all market cycles come to an end, and a new cycle begins. You don't want to become a perma-bear, so we'll discuss some techniques that will get you back on the bullish side at the right time. This is an overlay of market cycles, what stocks are doing, versus economic cycles, what the broad economy is doing. The red section is the market cycle, and the green section is the economic cycle. The key takeaway here is that market movement precedes economic movement. The markets are forward-looking and will move before the economy does. They will enter a downtrend before the economy actually enters a recession, and they will enter an uptrend before the economy fully recovers. At the top of the overlay are broad market sectors and when they generally perform best. At market tops, basic materials, energy, and consumer staples tend to perform best. At market bottoms, financials, cyclicals, and technology tend to perform best. This is a broad overview, so be sure to check what is actually happening in the markets. This is a chart of monthly candles of the S&P ETF, going all the way back to 2000. You can see from 2000 to 2003 we had the dot-com crash. Then from 2008 to March of 2009 we had the bear market from the 2008 financial crisis. From there, it was a steady rise up until March of 2020, when the government shut down the economy due to COVID-19. The move was sharp and fast, but you can see that the market recovered very quickly and went on to make excellent gains in 2020 and 2021, essentially going parabolic. For over a year, Maverick Trading has been advising our traders that yes, we were in a bubble, but to take advantage of the bubble and to make money on the long side. Which brings us to the present day in April of 2022. You can clearly see that people are right to be asking if we're about to enter a bear market. Is the bubble popping, and how do you make money from it? If you've been in the markets for more than a month, you've probably heard terms like pullback, correction, and crash bandied about, but let's take a minute to define each of those terms so that we're all on the same page. Anything less than a 5% move downward is just considered normal market movement. A bull pullback is a downward move at least 5%, but less than 10%. In a normal bull market, you'll see pullbacks several times a year, and the market bounces back pretty quickly. A correction is a larger drop in an uptrend that is at least 10%, but less than 20%. A normal bull market will see these about once a year. Now we get to the big one, a market crash. A crash is defined as a decline of greater than 20% from the market's top and is the technical definition of a bear market. How do we tell if we're simply in a correction or if we're in the first stages of a crash? It's very difficult to do when you're on the ground actively investing or trading the markets. As I mentioned, corrections are a common occurrence and simply the price of doing business in the markets. But they rarely break longer-term support levels and are quick to recover regardless of the catalyst of the correction. Crashes are rare and almost always follow a bubble. They don't always have to start from on an all-time high, meaning a correction can turn into a crash. Crashes are very slow to bottom or even bounce. You can see in the middle of the screen is a quote from Warren Buffett, who is one of the most quotable people out there. He said, "Only when the tide goes out do you discover who's been swimming naked." Meaning only when you have a market crash or a deep correction do you find out who's been over-levered and who's been trading with proper risk management. So, what are the characteristics of a bear market? In general, you want to be able to identify a series of lower swing highs and even lower swing lows. You're going to see increased volatility both to the upside and the downside. The VIX, the volatility index, is going to have elevated readings with periodic spikes. Next, you have to remember that the moves in a bear market can be fast and violent, and that really is the best way to describe it. Violent moves to the upside are possible, but they won't totally erase the moves to the downside. The last point is going to seem at odds with everything else, but this is real life. You're going to see periods where the market just seems to meander sideways or slightly downward. It's like that friend in high school who didn't really do anything after graduation, and then 10 years later he's living in a studio apartment with pizza boxes stacked to the counter and playing Xbox in his bathrobe. It's not a good image, but you get the point. So, let's get to the main question. Are we entering a bear market? This is a daily chart of the spiders going back to late July of 2021, so about 8-9 months. You can see that we were in a nice uptrend, but then had a decent pullback through all of September. But we put in a bottom in the first part of October and went on to make new highs in the beginning of November. Here's where it starts to get interesting. You can see through November and into December the price action was just sideways and volatile. The second half of December we put in a new high and made a high tight flag pattern. We attempted to break out of that but immediately failed. We failed nearly all of January but found support at the October lows. From there you can see clearly we've had multiple rallies and failures, really a classic bear rally pattern. Finally you can see that the support at the October and January lows was decisively broken and new support was established. And here's where you see the violent moves to the upside. We had an 11% move in a period of about 2 weeks where we tried to make a new swing high and we didn't quite do it. If you were short this entire time, you really were going through some pain. So this is what we mean, this is where risk management comes in. These bear markets can have some violent moves to the upside, and we just saw that right here, but you can immediately see that we turned right over and we're back down there at the previous lows. Okay, so right now, with the market action that we've had, we can definitively say that we're in correction territory. Once we break below 384 on the spiders, that will be the technical definition of a market crash, and we will be in bear market territory at that. Now, I think we achieved that, and our traders at Maverick Trading that are trading our capital, they've been lining their portfolios to take advantage of the downward moves. So, in short, we've been putting our money where our mouth is. Now that we've established that we're likely going to experience a bear market, let's talk about the differences between investors and traders and how they can approach this type of market. First, the investors. They have a longer time horizon for their positions. Largely, their investment decisions are based on the fundamentals of the economy and the individual companies they invest in. Investors are buy and hold types because they've done in-depth research on their holdings, and they can be quite loyal to their positions as well. Because they are buy and hold types, they are accustomed to sitting through normal market volatility. Unfortunately, this also means that bear markets can often catch them off guard, and they don't realize the extent of their exposure until the damage is already done. Investors have limited options in a bear market. They can wait it out, which if they don't need that capital for many years and are consistently putting additional capital to work, they will probably be fine. They won't like to look at the value of their portfolio for a few years, but they will be okay. Investors that are going to need that capital within the next few years are probably going to want to go to cash. They will take a hit from inflation, especially in this environment, but they won't have the market risk to take an even bigger bite out of their portfolios. It's better to suffer 10% inflation than it is to take a 30% loss in the market. They can always get back in when things turn bullish. Let's compare all that to traders. Traders have a shorter time horizon for their trades. I'm not talking about scalpers and day traders, but about swing and position traders whose holding periods are from a few days to several months. Instead of looking at a company's fundamentals, traders look at technical indicators that are strictly tied to price action. I say this next part in the most flattering way possible because this includes me. But traders have a very mercenary outlook with regard to their positions. We will ruthlessly cut losers, and we're going to focus our efforts where there's the most money to be made. Traders tend to watch market conditions closely, and their portfolios are probably already leaning to the bearish side. They have more options than the investors do in front of them. but waited out is not one of them. A trader who tries to wait out a correction or a crash will not be a trader for long because his capital would have gone up in flames. When the market action is murky or trendless, the trader can go to cash, but their other option is to actively trade in a bear market. So what are the steps you need to take to make money in a bear market? The first thing you need to do is change your mindset, and for many people this won't be easy. The problem is that we've been conditioned, and to an extent rightly so, that markets rise. Remember that it's been 13 years since we saw our last bear market. That's a long time to build habits. The second issue is that everybody thinks they're a genius in a bull market. All you have to do in a bull market is buy something and wait for it to go up. Everybody looks around and says, how hard can this be? Third, when volatility hits a market, you have a ton of competing emotions all screaming in your head. Fear that the market is going to make you lose money. Greed in that you want the market to recover and continue making you money. Fear of missing out because what happens if you go to cash and the market recovers, then you'll have foregone all those potential gains. If you've not seen a market like this before, all these competing thoughts can lead to a mental paralysis where you do nothing. Our ego also gets in the way in a bear market as well. It makes it hard to book a loss, especially when your entire portfolio takes a hit. People are conditioned that they want to be right. That's what feeds their ego. It's very, very difficult for people to say, I may be wrong. Should I just take the loss and move on? So, what do you need to do? First, you have to admit that market conditions are changing or have changed. Now, that's very difficult for some people to do. They have to take a look at it objectively. They have to trade the market in front of them, not the one they want it to be, and that can be very difficult for a lot of people. Next, you have to decide how much pain you will take on each position and for your entire portfolio. If you want to be long some selective things, we're going to talk about that later, that's fine. You can do that. But what you have to do is decide beforehand, and this is just a normal part of trading in a trading plan, what you're willing to risk. And then once that position has been reached, you take the loss and move on to the next thing. You have to do the same thing for your portfolio. How much of your portfolio are you willing to risk before you just go to cash? You have to begin to decide that. This also applies to the bearish side as well. If you take a bearish position and it goes against you, you still have to decide how much you're willing to risk, how much you're willing to lose, how much pain you're willing to take on the bearish positions as well before you go to cash and preserve your capital. You also have to embrace the fact that you can make money in a bear market if you know what you're doing. This is very hard for a lot of people to do because they've, as I said, been conditioned in that bull market for a long time, and Wall Street has largely conditioned them as well that they need to be buy and hold investors and that they'll be fine as long as they just stay in the market long enough. Well, it's very difficult to do. And if you've been told repeatedly that you can't make money in a bear market, you tend to believe it. If you can embrace that you can make money, then there's no reason not to. So let's talk portfolio strategy in a bear market. Generally, instead of buying the dips, you're going to short the rallies after confirmation. And here we can see 5 places where you could have gotten in, and this is in the recent past. Really all you'd have to do is wait till you have a lower high and a lower low from the previous day, and then that's a good place to enter a short position. And you can see there's quite a few of them right there. Your time horizon is either going to be very long or very short. And by very short, I mean within a week, where you can just take advantage of a discrete move in the stock, either up or down, mostly to the downside. Or very long is in several months, where you're going to use something like a diagonal put spread, or some sort of long-term spread to keep you in that issue so you can withstand the volatility. Now that you have the broad strategy clear in your head, let's talk about a few techniques, the actual tactics that you're going to use in a bear market. The first is the married put. That's simply where you own a stock outright, but buy the right number of put options to give you the protection to the downside. You have to remember that rising volatility in a bear market makes options more expensive, but you're using them to protect you in the short term while you liquidate your positions in the underlying stock. Depending on your time horizon, after you've liquidated the stock, you can keep the puts and continue to make money while the stock keeps falling. The next technique is simply shorting stocks. You have to have a margin account for this, and you can't do it in an ERISA account. You have to use good risk management so that a sudden rally in the stock doesn't cause large losses, and your broker may raise margin requirements on certain stocks. At Maverick, all of our traders have access to portfolio margin, but if you're trading a small retail account with Reg T margin, this can be an issue. This next technique is going to be controversial for some people, and you should really research the ins and outs of it to see if it's right for you. That is using inverse and leveraged ETFs. You have to commit to strict risk management in order to be successful, but when you are, it's like using rocket fuel to generate profits. This technique is really only suitable for short-term trades because there's a decaying mechanism in these types of ETFs. The upside is that you can use these ETFs in an ERISA account. The next technique is near and dear to me since I co-wrote a book about it, and that's using option spreads. This is actually an umbrella term that covers quite a few separate techniques. Using option spreads requires an in-depth understanding and knowledge of options, which would take more time than I have in this video to explain. I mean, realistically, the traders that we have at Maverick Trading go through about 200-250 hours of detailed instruction before we let them trade our capital. Now, these are also time-sensitive techniques, so you have to be right on direction and right on your timing. But by using spreads, you're also hedging out the volatility in the options themselves. I like to use spreads because they often require less margin than shorting the stocks themselves, meaning you can put on a wider variety of positions, increasing your odds of success. Finally, cash is always a position in any market. What do you have to consider when trading Forex and crypto in a bear market? Now, Bitcoin came out in 2009, just as the last bear market was bottoming, so no one has seen how cryptocurrencies behave in a bear market, but we can make some estimates. You have to remember that crypto and Forex trading is all pairs trading. In pairs trading, you're pitting a strong currency against a weak one. That pairing will give you a price, and that price will be able to be charted. In trading anything, it all comes down to a price and a chart. The key takeaway is that a bear market is, by definition, a risk-off environment. The best thing you can do is educate yourself on what currencies are traditionally strong and weak in a risk-off environment, and watch those pairs carefully. The second takeaway is that traditional markets and currency correlations can easily become decoupled in a bear market. So while you may enter a trade under a fundamental thesis, if that thesis becomes inoperable, you have to be prepared to exit the trade. So how do you manage a portfolio in a bear market? In a bull market, as I said before, everyone is a genius. All you have to do is buy something and wait for it to go up. For people who have never seen a bear market close up, there's going to be a real desire to short everything out there, to have your entire portfolio be short the market. Unfortunately, this is courting disaster. While it is really gratifying to be making money hand over fist as the market falls, you have to keep in mind that a bear market also produces sharp rallies, and these can decimate your portfolio if you don't know how to structure it. Even in a bear market, there are going to be sectors that will outperform. Just compare the energy sector to the rest of the S&P right now, and you'll see what I mean. There's also going to be individual stocks that can make gains. Even those that can just tread water and hold in there are outperforming a downtrending market. The stocks that can hang in there during a bear market are the first ones to make gains during a rally. What I'm saying is that most of your portfolio is going to be short, and it will be short the very weakest stocks, but that you should also be long the strong stocks in the strongest sectors at the same time. You should really treat your whole portfolio as its own hedge fund, being long the strongest and short the weakest. We can't stress that enough. You know, at Maverick Trading, we train our traders that are using our capital to do this. It's called basket trading, and it works in any market environment. As I said, you can make a lot of money in a bear market, but with any market cycle, one period ends and another begins. So you have to keep yourself from becoming a perma-bear. Bear markets, on average, last 15 months. And the average decline is 34%. These aren't set in stone, but they are factoids to keep in the back of your mind. You have to remember that market action precedes economic activity and economic reports. So when things look the darkest in the economy, this is a ripe time for the market to put in a bottom. You'll be able to tell a bottom is coming when individual sectors stop making lower lows, put in a support level, and then start to claw their way back up. When you see this happening, you want to increase your long positions in the best stocks in those outperforming sectors. At the same time, you'll be liquidating your short positions as they stop moving down. The broad markets will follow the sectors. Most people only look at charts of the broad markets and then search for individual stocks and completely neglect looking at what the sectors are doing. Take the time to look at the sectors, and you'll be able to spot changes in trends much earlier than people who don't. When you follow this strategy, your portfolio will naturally and gradually transition back to being bullish when the time comes. So let's wrap this up. The question on everyone's mind is this a correction or the beginning of a bear market? Well, time will tell, but you need to trade the market in front of you, and right now it's looking really bearish. To survive and even prosper, you have to embrace the concept that you can not only preserve capital in a bear market, but you can actively profit in one as well. To actively profit, you need to educate yourself on what works in a bear market. Finally, managing risk has to be your first priority, regardless of market conditions. Thanks for watching, and we hope that you learned a few things that you can use to weather the current market environment. If you're interested in learning how traders profit in environments like this, please visit MaverickTrading.com if you're interested in trading stocks and options, or MaverickCurrencies.com if you're interested in Forex and cryptos. Good trading, everyone. Thank you for watching. We'd appreciate it if you could leave us a like and be sure to subscribe to get access to our newest content. To get access to the complete content library in this series, click on the link in the description below. For more information on Maverick Trading, visit MaverickTrading.com. Maverick Trading, powering the world, one trader at a time.